engaged, and I'm sure that's a really good idea. So what we're going to do now is go through the groups and ask the experts who led the conversations to tell us some of the key learnings. Paul, can I tell us about disruptions first?
We talked quite a lot, but variously, about quantified self and how that might apply across the industry, so to all products through life and GI, and how that might manifest in terms of bringing together a variety of different feeds from different product providers and different APIs, and how that might work for the consumer. And we looked at kind of what the time frame for that might be. I think the general consensus was that was around about it was already happening. We looked at also the flip side of that is the big kind of question is, how does the insurance industry cope or respond to that as a challenge? And I think the time frame felt around that was kind of 2 to 5 years, so it's lagging a little bit. And in terms of very specific examples of how technology and how things like quantified self can begin to disrupt things like claims, so how big data can be used. So we looked at how you can have root cause analysis for claims, so look at people's location, their recent history, maybe do reconstructions of the events using the data that you've got, that you know about people, look at behaviour and attitude of the customer, likelihood of fraud, although I think we all agreed that you probably couldn't predict whether or not they were drunk and how good they'd be at driving if they were drunk. And then in terms of marketing engagement, one of the big questions that we talked about was around how do you enable products to be found by the customer rather than targeted at the customer by the insurer. I think that's quite a key question that needs resolving. And then how will the insurers cope with this and defend margins was something that Michael was quite keen on.
So we basically came, one of the opening comments was a bad idea well executed will be a disruptor. So we were like, right, what is a bad idea? So a bad idea from the perspective of the industry.
Okay.
So basically it was like, right, what's that for me? And it's like bid for me in real time.
Yeah.
So basically you've got all your data, it goes into an exchange, and then the insurers actually bid for your business rather than you going up and trying to get that. Doing insurance on a daily basis, not you as an individual, but maybe some sort of software on your behalf, then basically assesses your day and then insures you on a daily basis on that. And then the whole location barbed wire thing. So basically if you're insured on your phone, you go into a certain location within a city and you're not insured there, and instantly it comes up and goes, right, do you want to reassess your insurance live? So that was some really interesting concepts there. Total disruption, the insurance exchange, basically if it was like, you gave the idea of Betfair, basically you're actually assessing the odds and where you want to play and where you want to bid. So that was a really nice way of looking at that. There was a lot of stuff around mobile photos and video. It was basically, so you could take a video of your home, you could take photos, you then store that into a certain claims area, and then when you actually come to claim, the insurer can look at it and go, yeah, sure, you've got all that there, you didn't actually lie. Although there was so much slack in that model anyway, we weren't sure whether you could get better pricing out of it. Claims, can you go for better external data sets? But then we came around the whole consent issue, and then it really came, there was a huge discussion around personal data in the vault. So basically you carry that data around with you all the time, and then you determine who you give that data to decide what kind of policy and information you're going to get back. There was another one as well, I think it was Olga was talking about the whole thing's boring, can't we make it more interesting and basically insure everything at once with the information that you've got? And I think there was a lot of sympathy for that actually. Bundling seemed like a really good idea. Behaviour as well, we've talked about people in specific locations. Is there a way that you could gamify behaviour? So if you've got like 50 million user base, you could actually build a game where you start to assess whether people are liars or whether people are trustworthy, whether they're really risk averse or whether they're extremely risky, and whether you could use that information again to assess some sort of premium. And then finally, that all then came down to the Amazon suggestion model, basically suggesting sort of things that you want, because they were talking about, originally when you had the IFA, they knew you so well, they could make really good tailored suggestions for you. Whereas now we seem to be in the world of the aggregator, and there's no real tailored suggestion. So then it was like, right, okay, can technology step in there and start giving you tailored advice? But of course, there are whole issues around regulation. I mean, I haven't done the discussion justice. It was absolutely brilliant. I mean, I've just chosen various things out of there.
Thank you, Mark.
It's interesting, actually. There's a very big overlap, actually, with the first two groups that have announced things. So we kind of had two parts to our discussion. peer-to-peer model and a marketplace disintermediation of insurance we see as an opportunity. We were also thinking a little bit about who holds the keys to the data as energycos, telcos, online retailers, supermarkets, airlines. We didn't think about it from necessarily a personal ownership point of view, but that's the industries that we see owning data that could be new entrants and disruptive. And then we were looking at marketplace models for insurance. Could you act on either side of the equation? So actually, individuals become insurers. That's kind of our big idea that was different to the ones we already mentioned. And then from kind of within the industry, we see potential for evolutionary change in terms of across a number of processes. So the efficiency gains through anything from improved analysis, looking at risk. We also see reduced cost of retention, potential for niche-specific insurance products, more efficient distribution channels, and another one that is kind of an aggregator, so a possibility for a claims comparison website to give customers a view actually who pays out on their claims and to what extent, and how trustworthy is a particular insurer. That's it.
Well, the reflections we got is the insurance industry has little direct contact with the final clients. There are lots of aggregators in the middle, or insurance for companies. There is little data. In the case where we can sell directly through the web, there are pretty good examples commented where they are able to get up to 300 columns of information for each of the visits, and this can be quite predictive. Okay, so this is one thing. Another is we have seen more options for disruption in the GI and motor and home. Especially we talk about one example of special insurance for vans and the good experience getting the sign up with the Facebook account. I think it was 1/3 of the people were signing and making some kind of recommendations. We really thought that the disruptive would be approaching the customers with a plain, clear product and not very complex things. But the way of approaching this should be targeted to the two main types of clients. One of them is 90% who wants to pay the less and not worry about the experience with the insurance, and every year just they need to renew the insurance. And the others are the ones that have experience with claims, and they are more worrisome about the industry and how they can work. So, as a general reflection, option for disruptive using big data, internally for general risk, for maybe for the pension schemes or general investment, but for user customization, there should be a more direct contact with the prospective client and take into account all the data the client could be providing. So, anyone from my group willing to comment more on this? I think. Thank you.
We took a slightly different approach. A key message was that big data can be applied anywhere in the value chain. Some people are focusing on certain areas, on sales or pricing, but it can apply anywhere, fraud detection, renewals, anything. But it's got to be focused on the customer journey. So there was talk earlier on about the transformations happening at the banks, consolidating multiple systems, putting in efficiencies. We wouldn't call that a disruption. We would just say that's an evolution, it's an incremental change. A disruption is something truly different, coming in that disrupts the behavior for the customer. We talked a lot about how it could be used and how you justify the investment in something new like big data. And it can be an enabler of an increased efficiency or better pricing, but it could also be a differentiator. to set yourself apart from the competition. But then we started challenging, well, how long could it be a differentiator for? Because so many things can be adopted. You can't protect copyright particularly easily in the insurance industry. And that led us to this mantra of, should you lead or just be an early adopter? And we think that is a really significant proposition to think about, is how much do you want to be leading the way in big data? How much do you think you'll get a unique profit that won't be then just usurped by your customers in the years to come? We thought about two different approaches. One is the classic, and it's the maybe old-fashioned conservative way of thinking. Okay, what's the business case? If I invest $2 million in this research, blah 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 blah, what's my potential benefit? And that can lead to some good decisions and get you to make some good investments. But perhaps for big data, a better approach is more transformational, and that is, all right, I don't care. I'm putting a few million aside. I'm locking some guys in a room. Come back to me in a year. Tell me what you can work with. Because that's the more likely way to lead to some sort of transformational change, especially in insurance. And there's two separate keys to things. So one is getting to know your data. So you could put a project in place that scans all your old claims forms, policy forms, any number of things to get data that you haven't got available, that you have within your possession, ready for you. But that's only good if you know what to do with it. So what are you going to do with it? What tools are you going to use, and what benefit are you going to get out of that data? And then, who wants to speak about it? Melinda or Andrea, do you want to talk about discovery as an example of a really interesting evolution change that's happened in insurance? Melinda?
Okay, so Discovery are a South African insurance company, concept insurance company, and their model, certainly within the health space, is really sort of quite interesting. So there's an organisation made a decision some 20 years ago to put data at the hub of their business, and that the insight that they gain from that data actually feeds all their actuarial and financial instruments and the whole infrastructure within the insurance businesses. On the health side, they have developed a really different model for managing risk. And at the same time have been very, very smart to recognise that actually when you buy an insurance product, you don't necessarily get huge value you don't get immediate value from it unless you actually make a claim or you use it. And actually, wouldn't it be better if we were to develop a proposition where we actually gave people real tangible value every day, immediately, which actually also has been tailored and personalised to their needs and their family situations. And so what they've been very clever at doing is really getting to know you as an individual, engaging you in their programme called Vitality, which is about leading healthy lifestyles. So actually, yes, we're in the business of selling you health insurance, but actually what we're most importantly is we want to actually understand you, and we want you to work with us, in partnership with us, to actually lead a healthy lifestyle. And for doing that, we are going to give you preferential or sort of perfect pricing, in respect to your health insurance product. But actually, what we're also going to give you is a whole heap of rewards and loyalty sort of value propositions, which for us as an insurance business is really important, because what that's going to do is that's going to keep you longer with us as a customer, so you become much more stickier. But at the same time, that we're always building up a much bigger, richer picture of you as an individual customer, which we're then proactively going out to you and actually offering new ideas and suggestions in terms of how we might really continue to engage. So it's almost, prevention is absolutely very key as part of their model. It's about not just us as an insurer holding the risk, but it's actually moving towards a more shared risk approach to insurance, and that the consumer is understanding that actually, if I work with you in a different way and I take on board some of this accountability of insurance risk, then I know that I'm going to be rewarded for that.
Nice quick question on that. Do they also sell annuities, and are they successful in selling those annuities to those same customers?
certainly in South Africa, they have been very successful in launching and using this Vitality program and integrating it within my business. And also within the
Okay. Okay, we'll get discussion later. Can we have
Our discussion kind of went all over the place, but there were a lot of very interesting points made, and I just want to pick up on some of the ones that haven't been made already. One was that we started off talking quite a lot about pricing, and as you use data more and model it better, obviously you become much more perfect at pricing. Initially that's a benefit and a market advantage for the people who are good at that. Eventually there becomes no such thing as pooled risk, and the insurance industry needs to have quite a major rethink. So I think there's an initial advantage, but then potentially an industry disruption along the way from that. We also talked a lot about the ethics and the consumer response to using personal data to price things, whether the consumer is completely aware of how that's used or not. We posited that there might be a backlash to the NSA revelations, which meant people may be less willing to allow their data to be used rather than more. And we've got a good picture of P2P insurance, which I think was mentioned earlier as well, but the idea that if the industry radically reshapes, then is there space to instead think about peer-to-peer rather than a top-down model. The fact that Internet of Things may enable us to, again, offer different packagings of insurance products and just more insightful understanding of objects and those objects' lives so that we can insure them in a more nuanced way. And this idea was mentioned before about the idea of mining how insurance companies respond to claims. So we identified that maybe many insurance markets are actually not that price sensitive, and getting better pricing is not particularly interesting from an industry point of view. However, enabling consumers to trust that you will pay out when they have a problem could be a very powerful thing. And one way to do that may be to allow consumers to grant their claims data upwards to some kind of centralised source, which then offers rigorous data around who pays out on what.
It's public data, really.
Sorry?
It's publicly available. You can see claims pay out percentages.
Yeah.
It's publicly available.
Yeah, so potentially it can be more fine-grained. Consumers could choose to grant more fine-grained information about themselves, their risk. But you're right. Yeah, the top level is public already. We're also talking about disruption within the industry organisationally, and we felt that the actuarial part of the industry is already actually very good at the types of skills and thinking that are needed for much of big data. And in terms of refining how actuarial processes happen, potentially it's an evolution for that part of the business. But that there are other aspects of the business that could be disrupted by incomers or by isolated, innovative units within the industry. And that technology providers can potentially just package small parts of the value chain, as they do currently in banking, to add value to the whole collection. We also noted that regulation is actually potentially going to close down on use of data, so it may prevent insurers from offering interestingly packaged services or partnerships or things like the Vitality program we just talked about. And then finally we came back again to pricing and said that although pricing is potentially not so core in many industries and in many parts of the insurance industry, personal medical insurance is probably a separate issue where the pricing is high and consumers potentially are willing to share data, either quantified self or other data about their health and behaviour, which enables them to change their behaviour and the insurer to offer them a better price. And I think that was about all of it.
Thank you.
I mean, we tried to think about it a little bit, what's going to be happening internally, disrupting to the organisations, and externally. So the internal, I guess, is some of the peer-to-peer stuff. Externally, I think the access to open data, not just any big data, but the accessibility of all sorts of data sets is going to help people to disrupt and open up the market a little bit more to new entrants and the like. And I think we had a big thing here about building trust with the consumer, because the financial service industry as a whole has had a struggle with that. So things like rating your insurance provider on delivery. and you've got a product set, and obviously if you had a crash, then are they actually going to pay out? Is a small print going to allow you to do that or not? And that's one of the key things. So some of the ratings and the data access that you could get there. We're thinking about the value chain as well. I think greater accessibility and open data will allow the investment houses at the end of it to actually understand what product sets they need to invest on and the mandates of all of the clients that they're investing on behalf of. So are they investing on for GI guys or the life pensions, or and how that particular returns profile will change over time. I think it's interesting, I don't know, Michael, whether you were referring to that earlier when you were talking about customers on one part of the business, then are you able to sell in your annuity business as well? Because on the health side, the more you know about people, it's great, you get a good deal because you'll get better health insurance. As soon as you go to annuities, the longer you live, the worse your deal will get. So do you want to suddenly start smoking and drinking as soon as you get to retirement?
Yes.
But yeah, absolutely. But no, that value chain is something that the customer actually, there's no benefit if you're giving them more data at the annuity point, which is quite often where your biggest pot of money is at the greatest risk. So that's an interesting concept that is all part of the lifestyle. So,
Thank you very much for this. Okay, very quick, about 5 minutes.